This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 149 was recorded on January 10th, 2019. I'm Erik Townsend. Volatility guru and fund manager Chris Cole returns as this week's feature interview guest. My strong advice to any new listeners is to go back and listen to my interview with Chris from a year ago, January 25th, 2018 to be specific, when we covered the short volatility trade in detail. We're going to pick up today where that interview left off, so a thorough understanding of both the explicit and implicit short vol trade is a prerequisite to understanding and getting the most out of today's interview. You'll find a link to play Chris's January 2018 interview in your Research Roundup email, or there's a link next to Chris's photo on our homepage at macrovoices.com. Our strong advice is to listen to that interview first if you haven't heard it already. Be sure to stay tuned after the feature interview when Patrick and I will discuss Chris Cole's interview, along with the coming economic downturn and what it could mean in terms of social and geopolitical risks and consequences.
And I'm Patrick Ceresna. Now, Erik, let's jump right into the S&P 500. We are just a few ticks away from printing 2,600, which is almost 300 S&P points from the low of the market just in December. What's your take on all of this?
Well, I remain persuaded that the cyclical bear market has begun. And what we've been saying for several weeks, and frankly, we were a little bit too early with this call, is, hey, bear market or no bear market, you got to have bear market rallies, and we're overdue for a bounce here. And I've been looking for a bounce in earnest. Well, that bounce in earnest has finally begun. Charlie McElligott agrees with that view. He's saying specifically that the CTAs, the programmatic traders, look for a daily close above 2632. That's another 35 points above where we are as we're speaking on Thursday afternoon. Look for that level as a daily close for where the CTAs are going to flip bullish and do a whole bunch more buying. Now, I'm not playing this from the long side. I missed the entry opportunity. I know your big picture trading members got in on it. What I'm looking for really is I want to short this when we get to the high, when we get to the top of what I'm convinced is now a bear market rally. Question is, when is that? I think it could be quite a few weeks, maybe even months into the future. I'm going to be asking some of our feature interview guests in coming shows for that one. Meanwhile, right now, the trend is going to be up, at least short term, but I'm convinced it's just a bear market rally.
All right, so let's move on to the dollar index because we've seen some weakness in the dollar here over the last few weeks. Are you convinced that this is something big, or is this just a consolidation in your mind?
I still think it's a consolidation. Now, we had one daily close below 95, and that was definitely cause for raised eyebrows, but not reason to abandon my view. The fundamentals are still there for the dollar squeeze higher, and this is very much the Jeff Snyder view that we've discussed quite a bit on this program. The thing is, you've got to look at this in context, Patrick. We're in the middle of the market digesting this bearish pivot perception, which we've kind of flip-flopped back and forth in terms of what the perception is, whether it's a rate hike or a rate cut comes next. We seem to flip-flop every couple of days. But the market, a lot of people think that the Fed is flipping to getting ready to be more accommodative again. And if that's your view, it's easy to see why the dollar rally is taking a pause and, in fact, a pullback. But I think it's a pullback that will eventually resolve higher. Maybe we get down to 94. If so, I think it's a buy the dip opportunity. I don't see the dollar as topping out and crashing from here the way a lot of other people seem to be expecting.
All right, well, let's move on to crude oil because the dead cat bounce is on. The question is this going to have more to it? What's your thinking here on crude oil?
Well, Patrick, let's start with the inventory numbers. Crude oil drawing down 1.7 million barrels nationally versus analyst expectations of 2.7 million barrels. Cushing, Oklahoma, building 331,000 barrels. But boy, the real news, Patrick, was in the finished products. Huge builds. Gasoline building 5.5 million barrels. Distillates building 10.2 million barrels in 1 week, replenishing those very deep drawdowns that we'd seen several weeks ago. Production in the U.S. unchanged at 11.7 million barrels. Now, needless to say, with those massive product builds, this was very bearish news. The market, including crude oil, tanked on that news, but only for a few minutes. Saudi Arabia was at the ready to jawbone the market higher again. This is a pattern we used to see quite a bit, where right after inventory came out, there would be a bearish inventory report, and Saudi Arabia was ready with some kind of press statement. In this case, fantastic news. There's going to be an IPO of Saudi Aramco in 2021. Ta-da! Well, of course, people that have been following this story know that there was guaranteed to be an IPO of Saudi Aramco in 2017. Then it was 2018. Then it was on hold. Now it's back. Supposedly it's 2021. I don't believe any of these stories. They're going to float bonds now next before an IPO, because clearly Saudi Arabia needs money. Exactly how that gets translated to being bullish for oil prices, I'm not sure, but that's exactly what the market is doing. So even though we had a very bearish inventory report, the market has continued to go higher. A lot of people are saying, okay, that clearly has to mean that we're in the V-shaped recovery back to $80 plus. I'm not going to say that the bottom is necessarily in or not in. I think there is room still for lower lows to occur. Even if that doesn't happen, I think we get into some kind of consolidation, let's say in a range between 45 and 55 for the next few weeks. I will be very surprised if we get a decisive move above 60 to 65 and back towards those $80 numbers. I don't think that's in the cards, but we'll see what happens. Right now, the trend is up and it's strong.
I have to completely agree with you. I've been looking for oil in the next couple of dollars to start hitting some overhead resistance. I don't know if that's going to be where the final top will come in, but I think that this is getting already a little bit long in the tooth on the bounce. But let's move on to gold, which has been struggling around that 1,300 round number. Is that it for gold? What's your take?
Well, I think that if my view that I've expressed quite a bit in the last several weeks is to be proven true, it kind of needs to be the top. I think there's a really strong case for a $1,300 top. What we see is a little bit of weakness, which I think will be temporary in the dollar index. In the next several weeks, I expect the dollar index to recover, move back above 96, and at that point, maybe gold continues to move lower. Now, if I'm going to be proven wrong, it's going to happen pretty quickly here, and what I'd really look for is a daily close above about 1350 on gold, and at that point, I just have to say, okay, look, I'm just plain wrong. It's time to reassess this market and figure out why gold is moving higher before I thought it would. And to be clear, I definitely have been predicting a really big move up in gold. I just thought we were going to go down further first before it started. Maybe I got the timing wrong and it's starting earlier than I thought. I'm not ready to throw in the towel yet. I'm still thinking maybe 1,300 is where it's going to top out. We'll see what happens. In the meantime, I'd say my conviction is not as strong. As much as I do think it should be topping and there's room for lower gold prices before we move higher, boy, I've been saying that and the price has been proving me wrong. So really it's make or break time for my view to be proven or disproven, and we'll see what happens in the next couple of weeks.
Well, let's move on to 10-year Treasury yields, which pretty much in just about 2 months wiped out 70 basis points from 3.25 down to, I think it hit a low somewhere near 255 on the downside. We finally got a bounce. We're about 273 at the time of recording on the yields. What's going on here? What do you think is coming next here?
Well, as you said, major bounce there. I'm still leaning toward lower lows, like this is that big counter trend bounce. and we're going to see a resumption of a move toward lower yields. Frankly, at the same time, I have to admit, I was caught off guard and surprised by how quickly we moved lower on yields. The other thing is with stocks recovering at the moment, as long as stocks continue to rally, that is less support for prices, and therefore it results in higher yields. So I think that maybe when we get a resumption of the bear market, when this bear market rally, if I'm correct that that's what it is in stocks, eventually tops out, could be several weeks into the future. When that happens and we start to move decisively down in the stock market again, that's when I would expect to see maybe a new lower low. So I wouldn't be surprised if we continue to move a little higher here, but I'm thinking that if I'm right about the stock market, then eventually we get lower yields on bonds before this is over. I will say again, my directional conviction is modest at this point. I was caught by surprise by how quickly we moved before, so I'm more watching carefully as opposed to trading this at this point.
All right. So before we move on to our feature interview, there was a couple of housekeeping things we had in mind. What's going on?
First of all, next week's show will be released early, late Tuesday night. We're going to say Wednesday morning is when the show should be ready. The reason, of course, is we'll be traveling to Vancouver for MacroVoices Live. Still time to sign up and join us. MacroVoices.com/live is where you can sign up to join us for our January 19th conference with 6 fantastic speakers. Be sure to get there in time for the 6 p.m. reception on Friday night. We had several people ask us on email whether or not it's okay to bring guests with them to the reception. Yes, you can bring guests to the receptions, but you need to be registered and have paid the fee in order to attend Patrick's live trading session on Friday or the main event on Saturday. But the Friday night and Saturday night receptions, you're welcome to bring unregistered guests to. The other thing we're going to try changing, and this is a change for the program format in general for 2019, by design, I intentionally don't spend a lot of time at the beginning of my interviews doing the tell me your life story, what's your background, and so forth. I try to get right into the meat of the interview. And people have suggested it might play a little bit better if we did an introduction to who the guest is and why we chose to bring them on this particular week.
Well, then I have to ask you, Erik, why are we bringing Chris Cole back on?
Well, that one is pretty simple. Chris, for anyone who doesn't know, is the man for equity volatility. He's so beautifully called the February vol complex blow-up that occurred last year, and he has just been fantastically prescient in his views. If I'm right about the equity market, where we stand right now is we're in a bear market rally, which will probably fake everybody out, turn into a bull trap, get a bunch of retail investors back into the market before it reverses. When it does reverse, we could potentially be looking at some really scary downside risks. Who could be better to prepare us for what might be on the horizon than Chris Cole, who's just done so much research and whose view we respect so much. So that was the reason for getting Chris on for this week's feature interview.
So without any further ado, Erik's interview with Chris Cole is coming up as Macro Voices continues right here at MacroVoices.com.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me next on the program is Artemis Capital founder and CIO, Chris Cole. Chris, thanks so much for joining us on the program. Listeners, I really want to encourage you to listen to Chris's interview from January 2018 on the alchemy of risk, because we're going to be assuming your knowledge of the short vol trade, both implicit and explicit, as was described in great detail in that interview. You'll find the link to play that interview in your Research Roundup email or on our homepage next to Chris's picture at MacroVoices.com. Chris, welcome back. When we had you on before, you explained the short vol trade and where the risks were in both the explicit and implicit short vol trade. That was before the February event. So why don't we start with what happened in February, what broke and what didn't break, and perhaps, if it is applicable, what is still left that might break in the future?
Certainly, yeah. It's a pleasure to be back on the show, and I think the timing in February was perfect for the last interview. I'm happy to be back, but I'm also interested in kind of clearing up some of the misconceptions about volatility. Obviously, last year I wrote a paper called Volatility and the Alchemy of Risk that talked about $2 trillion of implicit and explicit short volatility exposure in the market. I used a metaphor to describe this. I said it was sort of like an Ouroboros, which is a Greek word meaning tail devourer. This is an ancient symbol of a snake consuming its own tail. And effectively, we have about $2 trillion worth of global financial strategies, institutional asset strategies that are either explicitly shorting volatility by shorting options or implicitly shorting volatility through a combination of financial engineering strategies. And in these types of strategies, volatility is both a source of return and an input for taking risk. So the more volatility goes down, the more risk is put on. The more volatility goes up, the more risk is taken off. And this creates a tremendous self-reflexivity and potential systemic risk. I think what we saw last February is actually just was the weak hand of the table being taken out by the short vol trade. A lot of people read my paper. They came to me and they said, congratulations on getting it so right, because there's this blow up of these short VIX ETP products that occurred actually literally within a couple days after the interview. And I said, you know what, that's not what I was referring to. Those short vol products, those VIX ETPs, the weak hands of the table, that was just the first phase of what is going to be a multi-year cycle and rebalance in the vol regime as many of these institutional short volatility strategies come unwound. Let me ask you a question. Let's just take a little pop quiz. When do you think volatility rose more? In February of last year or in January?
Sounds like a trick question to me, but I'll go with the dummy answer because everybody else would have said February.
Yeah, I think 99% of the people would say February volatility rose more. Actually, if you look at the absolute move in implied vol, fixed strike vols of the S&P 500, vol actually moved more in January than it moved in February of last year. A lot of that was actually right tail movement in volatility. I think that is quite shocking to most people. The vol spike in February was widely misunderstood. The media talked about this as a volatility event, but this was not a true vol event. It was a liquidity crisis as a result of a rapid repricing and tail risk. You had a lot of very weak hands at the table that were shorting volatility in the form of these VIX ETPs on the expectation of continued stability. And it was, put quite simply, there was a point where many of these strategies had never been tested in a true volatile environment. And when we had a revaluation of volatility higher, these weak hands at the table were taken out. And what we saw actually was not a fundamental repricing in vol driven by the credit cycle as much, or fundamentals, as much as it was the weakest hands at the table scrambling to buy tail risk insurance, not to hedge their portfolios, to hedge their careers. They were forced to buy tail risk insurance or face insolvency. This is analogous to some of the subprime lenders that blew out in the late 2006, 2007. The dumb money that was overlevered and was out of control and got taken out early. Of course, that dumb money gets taken out first. There's an initial panic. And then we begin to see a fundamental regime shift in volatility that comes later, after that dumb money is taken out. And this is what we've begun to see in the fourth quarter of 2018 heading into this year. And my point here is that in February, traders were not buying options because they thought volatility would increase. They were buying options because they were facing insolvency. And that bid on tail risk insurance is what caused the vol in the VIX to shoot up so dramatically. And it was a blowout of this teeny portion of the global shortfall trade. I talk about this Ouroboros, $2 trillion worth of shortfall exposure. These VIX ETPs were only about $5 billion, $5 billion of $2 trillion. We still have the much larger $2 trillion unwind in the global shortfall trade that has just begun to start. And this is a fundamental regime shift in volatility that, if history is any guide, will last anywhere between 1 to 3 years and presents tremendous opportunity for different strategies that profit from change, and coincides with a not only quantitative tightening, but also the evolution of the debt and leverage cycle.
So if this unwind that has just begun has essentially most of $2 trillion left to unwind, does it happen in extraordinary events like we saw last February where all of a sudden there's a spike and things blow up? Or is it a slow, gradual churn where we're seeing unwinding of certain trades? And if so, or in either case, what are the effects of it? Where do we look to see that show up in markets?
Well, the answer could be both, actually. In my paper last year, I talked about the 1987 as an interesting allegory for the potential unwind of different systematic strategies. In the Black Monday 1987, most people think about the one day where the stock market dropped 20%. They don't think about the fact that in early 1987, inflation was actually lower than where it is today, and how rates shot up 300 basis points. And that caused liquidity seize up that initially started to show through in interbank lending and higher credit spreads, then spread to a 20% drawdown in equity markets all before Black Monday occurred. So I'd like to sort of point out this idea that these short ball strategies and these institutional strategies, many institutions seeking to use financial engineering to apply leverage to get extra yield because they're not getting it on their fixed income portfolio, these strategies are a little like a barrel of nitroglycerin sitting in the office. You could come to an office, and I could go to your offices. I don't know where you guys are located, but I could sit there and say, "Oh, what's that then barrel? These are beautiful offices, but what's in that barrel?" And you're like, "Oh, it's a barrel of nitroglycerin." I'll be like, "Oh my God, what is it doing there that could blow up 3 city blocks?" You'd be like, "Oh, it's no big deal. You know, the bank pays me to keep it here." And I'm like, "That's terrifying. All it takes is a small fire for that thing to explode." You'd be like, "Oh, it's no big deal. You know, we've been adding to the stockpile of nitroglycerin for 5 years. It's never gone off. What's the big deal?" It takes a fire. It takes a fire. And when that fire starts, something else starts that fire. And when that fire spreads, it then spreads to the barrel of nitroglycerin. And then the nitroglycerin explodes, blowing up 3 city blocks. So in this analogy, if we go back to 1987, naturally the fire starts in credits and rates. You have, in 1987, inflation's lower than where it is today. Inflation shoots up 350 basis points. Rates shoot up an equal amount. And all of a sudden, you have a liquidity crisis. That causes markets to sell off, which then causes the self-reflexive strategy of portfolio insurance to unwind all at once. The fire is very slow. The fire takes place over a period of 1 to 3 months. Before that reaches the barrel of nitroglycerin. We saw the same thing in 2007 to 2008. The weak players got taken out of the market in late 06, 07. By the summer of 2008, we had people going around saying, "Oh, the global economy's fine. Oh, financial stocks are cheap." We had various sovereign wealth funds buying into different financial companies and saying, "The worst is over. Subprime is contained. No big deal." And then the spark hit the barrel of nitroglycerin called Lehman Brothers, and the whole economy went into a tailspin. So today, the question is, what is going to start the fire? And we have seen the fire start this quarter. The beginning of the fire has already started. What we've seen is quantitative tightening by central banks. There has been a withdrawal of, now everyone talks about rate cuts, or everyone talks about rate increases. And, there's so much attention. And nobody pays attention to the fact that global central bank balance sheets are gradually shrinking. So by the Atlanta Fed Funds, a shadow Fed Funds model, for, approximately every $100 billion worth of withdrawal of central bank balance sheet equals about 10 basis points. So what we end up seeing is we've already had $500 billion of quantitative tightening in the reduction of central bank balance sheets. We're going to have another $600 billion of reduction in balance sheets this year. So regardless of whether the Fed raises rates or not, there is a rate increase by the reduction of liquidity. This is happening globally. So we're seeing this with the United States, and Europe and the Bank of Japan are just getting started. This reduction is causing tighter liquidity conditions in credit. So as the global central bank balance sheets begin to decline, we see credit spreads begin to increase. So lo and behold, what do we see but high-yield OAS spreads, the borrowing cost on high-yield bonds, is now at levels that we last saw in 2007 or in 1998. Heading into both of those recessions. If that trend continues, it will be more and more difficult for lower credit quality companies to be able to access credit markets. This is coming at a point in time where there have never been a greater amount of companies that are the lowest leg of their investment grade. 49% of U.S. corporates are at the lowest tier of the investment credit rating spectrum. So these are companies that may face significant pressure and downgrades. If they get downgraded, they will crowd out some of the high-yield issuers. On top of that, we have over $1 trillion worth of high-yield loans that need to be refinanced over the next 4 years. The level of high-yield issuance that's going to be required doubles next year and then doubles again and then doubles again, according to Bank of America estimates. So we have this perfect storm of quantitative tightening, tremendous amount of supply that's going to be required, in addition to really poor credit quality among corporate America. And lo and behold, what do we see? Right now, the amount of corporate debt to GDP is at the highest level in history. 47% corporate debt to GDP. Now, that alone doesn't necessitate a crisis. But when you have that level of leverage coupled with rising interest rates, with rising credit spreads, with quantitative tightening globally, you've got a problem. This all coincides with the volatility regime because volatility is the brother of credit. If you want to look to see what happens to equity vol, when do we see rising periods of equity volatility? It coincides with changes in the credit cycle. It just makes natural sense. So what we are going to see coming forward is, should this trajectory continue, it is always possible they go back to QE 4, 5, 6, 7, 8, 9. And if they do that, risk will be transmuted in other ways. We're going to see a populist uprising. I'm quite afraid if they do that. We'll see other risks. But should this continue, the piper has to be paid at some point. And there will be a natural transmutation of that risk through a higher vol regime. And it's not going to be a one-day event. It's not going to be, oh, yeah, hey, vol shot up to 40 and now it's back down. No, what we're looking at is something very, very different. It's going to be a new golden regime for strategies and hedge funds that profit from change. These are vol traders, global macro traders, CTAs, all the strategies people hate right now are going to be well suited to this regime. I think there's a fundamental misunderstanding about what volatility investing is and what volatility is. Most people think it's about waiting for this singular crash. That's what people are expecting and wanting. But it's better to think about an investment in volatility as profiting from a period of change. And that change can happen on the left tail and the right tail. These regime shifts in vol markets and credit markets, they don't occur over a weekend or a day or a week. They take months and years. And if history is any guide, this is the type of regime we saw leading in the late 90s into 2000. It's the type of regime change we saw in the period of 2006 leading into 2008, 2009. It's the type of regime shift we saw leading into the Great Depression. These are regimes. They're phases through time. And we are in the first inning of this. We are at the very beginning of this. So what we saw in February of last year, what we saw in the fourth quarter of last year is just an appetizer for a much bigger main course in vol and deleveraging.
Chris, that brings to mind a narrative that I feel has brought a tremendous amount of complacency to institutional finance. You'll hear this from so many people. They just say, look, yeah, I get it. I get the logic for why quantitative tightening could be really disastrous for markets. But you know what? I'm not going to worry about it because if things start to go south in a big way, the Fed's going to come to the rescue. They always do. Politically, they need to. I know they're going to bail us out. What could happen with the unwind of this short vol complex that might make it impossible for the Fed to actually save the day after all?
Oh, I think that's easy, actually. So if you look back in 1987, it actually is inflation is the obvious answer to that. I mean, in 87, one of the things that drove the Black Monday crash was that you actually had an increase in CPI. It was a huge run-up in inflation, and so they weren't able to cut. So that could be one reason. So you could have a crisis where there is an increase in inflation prior to the crisis, an increase in rates, and that becomes the source of the crisis, and then they're not able to cut into that. But there's this concept all the time about this central bank put. I don't need to buy protection. I don't need to have exposure. I don't need anything other than index funds because of the central bank put option. And actually, what's really interesting is that the decline in markets this fourth quarter, the rise in volatility was one of the lowest increases in vol given the decline in markets that we've ever seen in history. Actually, the steepness of fixed strike vols, the reaction of volatility was incredibly numb to the move in markets. And one of the reasons for that, or one of the theoretical reasons for that, is that investors just don't feel a need to hedge because they say, oh, well, whatever. Why would I bid up portfolio insurance? Why would I bid up the cost of fear and buy into volatility when I know that the Fed may not increase interest rates or even cut? But, the media doesn't make a big deal about it, but there was rioting in Paris. There's absolutely rioting in Paris. So you sit down and this belief system that they can always cut interest rates and they can always do another round of QE. Well, at a certain point, if you have a stock portfolio, that's going to double. If you have a bond portfolio, it's going to do okay. And if you have real estate, it's going to double and triple. But when you're already seeing this rise in populism, when you're already seeing the President of the United States tweet that the Fed chief should be fired, I think it really lends into question the efficacy socially of being able to do QE 4, 5, 6, 7, 8, 9. Will our institutions be able to handle – because, you can't destroy risk. You can only redistribute risk through time and form and transmit it through form. So if they want to remove the market price risk, they can do that, but it's going to come at the cost of the risk of rising populism. So I think that's something that's really interesting. I mean, look, this is the riots in Paris over a gas tax. This was in downtown Paris. This isn't the suburbs. This is where you take your wife and your kids. If that's not a wake-up call to where this income inequality problem is flowing to, then I don't know what is. So certainly they can do QE, 4, 5, 6, 7, 8, 9. Whatever, my home price is going to double and triple, and all the hedge fund managers and bankers of the world will be fine. But there is going to be riots on every street if they continue that framework down the road. I think our leaders, certainly Powell is someone who has spoken about the problems of moral hazard. And I think that's something to keep in mind. It does not destroy risk. It transmutes the risk from asset prices into social risk. And look, let's just sit back and think about this logically too. Right now, trading volume in the S&P 500 is back to where it was in the late 90s. Now, wait a minute. How is that possible? How is it possible that we've had this massive bull market and the trading volumes is at lows of over a decade? Well, it's easy. There's not as many shares out there. Why aren't there that many shares out there? Well, literally, the stock market is self-cannibalizing. All of these companies, the same companies that are leveraging themselves to the tilt, it's why 49% of the companies are now one notch above junk, and why there's $9 trillion worth of corporate debt out there. It's because what we've done is we've had a system where companies using ultra-low interest rates issue debt and buy back their shares. And by my estimates, approximately 40% of the price appreciation has come from share buybacks. Just last year, there was $1 trillion worth of share buybacks. So these low interest rates and this money printing, it's not actually creating fundamental growth. This is a financial accounting illusion that is being used to create the illusion of earnings per share growth by reducing the number of shares. I mean, can we do that for another decade? Is that going to solve all the problems that we have? Is that a viable solution to just engineer that type of growth ad nauseum? Some people would say yes, and maybe they're right, but I think we're going to see other forms of risk emerge that could be far worse than a 20 or 30% decline in the stock market.
Let's talk about the risk parity trade, which is a really big component of the implied short vol pyramid that you showed us in the January interview last year. It seems to me that the whole theory here is people feel that there's this immutable inverse correlation between stock and bond prices, and that gives them the courage, if you will, to lever up their bond holdings in order to match the volatility in their stock holdings. What would an unwind look like? And particularly, I think about that concept of reflexivity. If you got stocks and bonds both selling off at the same time, it seems to me there's a reflexive, self-reinforcing vicious cycle where what happens is they're both selling off. That means the correlation is gone. That causes more people to freak out and sell both, and that causes the problem to exacerbate more and more. Am I right to be concerned that that's one of the ways this could blow up, and is that a realistic scenario for how we might see a major meltdown in both the stock market and the bond market at the same time?
Yeah, it's completely a realistic scenario. And so, if we go back to the VIX ETP meltdown, the reflexivity in that, Artemis wrote about that in 2012. We theorized that was possible in 2012. There's a paper I released in 2015 that came from client writings that I'd done previously that talked about the potential performance of risk parity over 120 years. And it looked at the stock-bond correlation going over 120 years. Now, this is something people talk about now, but I think if you go back, that's not something people were really talking about much 5 or 6 years ago that Artemis has highlighted. So if you go to your average financial advisor, people say, well, what should I do with my money? And they'll say, put it in a 60-40 stock-bond split. You go to risk parity, of course, and risk parity is a little bit more expensive of a financial advisor. And they'll say, well, what you're going to do is you're going to lever your bonds, and you're going to use that to offset the exposure to equity. And so we have this seemingly unchallenged immutable law that is taught in every financial engineering program or MBA program that stocks and bonds have been anti-correlated with one another. When stocks go down, bonds go up, and vice versa. Certainly that has been true over my lifetime, as we've seen interest rates decline from U.S. Treasury rate declining from the mid-teens all the way down to 2% and lower. But if we look at 120 years, what has that stock-bond relationship done? And I think in our paper in 2015, we show this, and there's been a graph that has been replicated many, many times. Stocks and bonds have actually spent more time correlated with one another than they spent anti-correlated. Stocks and bonds are actually correlated with one another about 30% of the time. Now, correlated doesn't always mean that they both go down together. Correlated can mean that they both go up together. But if we look at periods where they go down together at the same time, that has occurred about 2% of the time over the last 120 years. And these periods are actually not just – I'm not talking about a month. I'm talking about 1 to 3 years where stocks and bonds decline at the same time. This has occurred in the early 1900s. It occurred for a period of time in the 1950s. It occurred in the late 1970s. So if you look at where current pension systems are funded at, There's significant funding gaps, very scary funding gaps in many of these pension systems, in some of the most high-tax states as well, states with the highest tax rates. And you look, and many of these systems have heavy exposure to the expectation of stock-bond anti-correlation. What is going to be worse? The equity market dropping 40%, or a situation where stocks and bonds are down 20% at the same time? This could be disastrous for the pension complex. It could create a dangerous cycle where you have pension funding gaps and then higher and higher taxes, and then people leaving and businesses leaving those types of states. It is a death spiral. But in addition to that, it could produce significant volatility that causes a massive unwind. Risk parity is a strategy that relies on vol exposure to size, and it could trigger many other types of financial engineering strategies that also rely on volatility as input to increase and decrease their exposure. So I think this is one of those things, people sit back and they say, what are the fallacies of finance? And, not too long ago, we sat back and said, oh, well, why in the world did we think that real estate couldn't decline all across the United States at the same time? How stupid were we? Especially when there's historical evidence of that. There was. Well, I think maybe in 10, 20 years, we could look back and say, how did we design a system that was levered to the expectation of this anti-correlation between these two asset classes when there's plenty of evidence that shows across history that there are many times where both stocks and bonds have declined at the same time together, particularly after long bull markets in bonds that has resulted in near zero interest rates.
Well, let me just interject and ask you to explain, am I correct in my understanding of this? That it seems to me like you don't need years of this. You need about one solid quarter of stocks and bonds declining markedly, double-digit decline, say, over the course of one quarter, at which point institutions are forced to say, our primary investment strategy doesn't work. On its face, the assumptions it's based on are broken. We have to abandon it. We don't have any choice. And at that point, it seems to me you have a forced unwind of a trade it's like the biggest thing in finance for the last 20 years. That can't be a pretty picture.
I will say one thing about a lot of the risk parity funds, and there's a lot of different ways that you can structure risk parity. But of all of the vol ecosystem, they're among the slowest to rebalance. So if you look at many of these self-reflexive Ouroboros style vol strategies, the ones that are fastest to rebalance are the guys like the explicit short volatility players are some of the fastest to rebalance. The vol rebalancing funds, the strategies that actually focus on volatility rebalancing of equity exposure. CTAs rebalance relatively quickly. The risk parity guys are actually some of the slowest to rebalance. That aside, it could take a month, but let me tell you, if you look across history, this type of stuff can happen for 2 to 3 years. So it's not just a taper tantrum 2013 scenario where a couple of risk parity funds have a bad month. I'm talking about 2 to 3 years of this type of middling performance or disastrous performance that could cause this kind of continuous unwind. So I absolutely, you can imagine types of scenarios, but that scenario that I'm describing, the 2 to 3 year period of losses in both stocks and bonds, that is not a theoretical. I am not describing a theoretical scenario. This has happened. It's happened many times across history. It will happen again. So this is not a theoretical. This is not me sitting around and imagining some disaster scenario. I am just simply explaining to you something that has occurred historically, particularly coming off a period where rates are this low. So if you're a individual investor or you're a institutional investor and you are not thinking about that, then you're just not doing your job. Here's the other element of it too. There's different types of strategies out there that profit from change and turbulence. And these are the true diversifiers. These are the true diversifiers. Things like long volatility exposure, things like certain types of CTAs, global macro managers that profit from change are your diversifiers in this disaster scenario. And they are, naturally, Artemis is part of that group, but it's very unpopular right now. That type of focus is very unpopular right now, as everyone wants to move to indexation. And everyone believes in risk premia and these financial engineering strategies coming off of a regime where you're looking to leverage yield instead of looking to provide opportunity from change. That change can happen on either tail. It can happen on either tail. This is another hypothetical. What's another scenario? Let's just imagine a scenario where stocks and bonds do nothing for 10 years. I want to talk about disaster scenarios, a high volatility environment where stocks and bonds whipsaw back and forth and do nothing for 10 years. Boy, I mean, not everything has to be this apocalypse left tail environment. What happens if a decade from now we've experienced high volatility, high whipsaw, and completely low returns out of every asset class? And that 8% pension return assumption that all these institutions have, you're not getting anywhere close to that. I think we are entering into, at a point where it's least popular, I think we might be entering into a golden era for active management and strategies that can benefit from these types of high vol regime switching worlds.
I couldn't agree with you more on that, but I want to come to a subject that I know is very much central to the way you do business at Artemis, which is, on one hand, it certainly is true. We can talk about all kinds of exceptional tail risk events that are going to happen someday. The thing is, in the meantime, you guys have to make returns for your clients every month, not just when the world is coming to an end. So it's counterintuitive to me because obviously the reason that it's been so intoxicating for so many people to get sucked into this short vol trade is because there's so much carry on the short side of the VIX term structure. So
there was.
There
used to be.
Well, I guess my point is you can't just be long, VIX futures and roll them every month and make money that way because there's money to be made in long vol. It's got to be more sophisticated than that. So give us a sense of what it takes to manage a long vol strategy that has to be profitable, not just as a hedge when the world blows up, but needs to make money, during the normal grind of business and maybe has an exceptional payback if the world starts to blow up. How do you structure a portfolio to do that around the vol complex?
The first thing to understand is that volatility is not just the left tail. It's not just the world ending. One of the highest periods of volatility in history was during the Weimar Republic Germany when they went into their hyperinflation. Vol went up to 2,000%, all on the right tail. So you can have periods where there is a massive amount of volatility with higher asset prices. A great example of that in recent history was during the NASDAQ bubble in the late 2000s. Volatility was actually averaging higher than where it is today, and the market was going up and up and up. You had a 100% increase in the stock market during a period of plus 20% or more volatility. So that's pretty amazing. You can have right tail and left tail vol. You just need movement. You need change. Vol is the profiting from change. I think, in terms of it's difficult to fully explain our entire suite of what we do, but I can give some glimpses of the philosophy behind it. I think one aspect is you can never predict what spark will cause a forest fire, but you can predict the underlying conditions that lead to a higher probability of a forest fire. So an example of that is that if you're looking to gauge whether or not a forest fire is going to start in California, the Forest Service does do this, you look at things like buildup of dry chaparral, high wind conditions, dry weather conditions, lots of lightning strikes. These things, when put together, incrementally increase the probability of a fire breaking out. Well, in the same vein, we can scan thousands of cross-asset global macro conditions and use those to probabilistically build an expectation as to whether or not right or left tail volatility will be realized in any given asset class. That produces an ability for us to dynamically size that exposure when the probability of a volatility wildfire is greatest. That's one of the most effective ways that we can do it. Another thing to do is to use vol-arb techniques. There's situations where you are paid to own volatility. Usually buying into a vol spike when term structures are inverted is an example of that type of opportunity, where you're actually paid to own that convexity exposure. There's other situations where I think in one of my papers I talked about this is the George Lucas trade, where when Lucas was making a space opera, which we now know as Star Wars, the studio came to him and he was given about $1 million salary. And he said, well, you know what? I don't want $1 million. Give me $150,000, but I want to own the merchandising sequel rights to my new property. Of course, we all know how that turned out, that $850,000 option that Lucas bought by giving up his carry turned into about $46 billion. Not a bad trade. George Lucas was a very smart options trader. So, to that extent, in some aspects, when you have an opportunity to own some linear carry, you can recycle that carry into very powerful convexity exposure. That convexity exposure on either tail. And that convexity exposure, it usually takes a big move for that convexity exposure to pay out. But that's an example of when you can carry volatility in an efficient way. So it's a combination of these types of strategies that enables you to own the optionality on change without the significant negative bleed. Can you do this yourself? Boy, it's tough. I mean, I've got a whole team. I've got a team of PhD data scientists and experts. We even have an Olympic swimmer on staff. And it takes an entire team scanning a lot of data and working very, very hard on this one specific task. So, yeah, you know what? Will you lose money buying VIX futures? Yeah, of course. Yeah, that's not a very smart way to do it. That's why it takes a lot of hard work and a lot of experts spending a lot of time and energy and effort and upfront money to be able to find smart ways to carry long vol exposure.
Unfortunately, Artemis's product is a hedge fund which is not available to our retail audience, but for our very large institutional and accredited investor audience who might be interested in investing and letting you guys do this work, how do they find out more and contact you in order to get a pitch meeting set up in order to learn about your fund?
We are a private partnership in that sense, and most of our investors are obviously either accredited, most of our investors are institutional, but if someone does kind of meet that qualification, certainly there's information on our website to that effect.
Okay, fantastic. Well, Chris, I can't thank you enough for another fantastic interview. I hope that last year was not an indication that we should expect 5 days from now that the world will come to an end, because we had you on the program again. But we'll see what happens in the vol complex, and we look forward to having you back on the program again soon. Patrick Ceresna and I will be back as MacroVoices continues right here at MacroVoices.com.
MacroVoices is a listener-driven program. Please email requests for specific future interview guests to requests@macrovoices.com. You can email questions for the program to mailbag@macrovoices.com, and we'll answer them on the air from time to time in our mailbag segment. We also welcome your suggestions for how we can improve the program. Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, what a great interview with Chris Cole. I just spent the last 20 minutes walking around my office looking for the nitroglycerin just to make sure I didn't have any in my office there. But that was actually a great analogy that he used. And it's this idea, though, that the fire has already started. And what's interesting about him using that analogy is this idea that it takes a little while for the fire to get nice and hot in order to ignite this. And the question is, has the fire started? In his mind, the fire has started, and it's the central banks shrinking their balance sheet, the tighter liquidity conditions, that is that flame that's going to trigger this. What's your take on that?
Yeah, I agree with that. And where I would draw the analogy a little bit further out is I would say it's just like the fire had already begun in 2007, not 2008, but we started seeing the volatility in markets. We started seeing bigger moves up and down. It was clear that there was a problem, and we didn't really get into the fireworks until the end of 2008. I think that 2018 was the 2007, and maybe where we are now is, that January of 2008, where there's still some up, there's still room for people to get caught into it's all over, it's all better now, before we eventually see the real fireworks. And of course, this is a different set of conditions. It's not the same cause and effect as 2008. I'm not predicting a repeat of 2008, but I think something just as big to the downside that is driven really more by central bankers' inability to defend and respond to a crisis. They've used up their ammunition, and I think we're about to test that. It's going to be really interesting to see how this plays out and how big of an event it leads to.
Know what else interested me was when he was talking about volatility, and he said volatility is the brother of credit. And I was fascinated by this because I'm a big fan of studying the credit cycle. Ray Dalio really put a lot of work out in there. And obviously I study volatility and follow that along. But what was interesting was that he connected the dots between the two. It was this idea that volatility and credit are very much intertwined in the same cycle. And that changes in the credit cycle actually correspond with the changes in the volatility regime. And when I started connecting the dots in the interview, that it's like, wow, if we are truly seeing the credit markets tightening, then this really, the ball is already rolling down the hill here in terms of how this is all going to play out. But what also got me really interested was when he's talking about how, well, this will spur on quantitative easing. And they might turn around and pump, QE 4, 5, 6, 7 out there, but this only is going to transmute the risk and potentially lead to populist uprisings. And I knew that this is something that's going to get you going. So let's get you started here. What's your thoughts on that?
Well, you definitely hit the nail on the head as far as what I thought was the most important part, not only of this interview, but a trend that I've been seeing overall. And that is the very, very smartest guys. Ray Dalio saying to people, look, yeah, we've got an economic event, and that's interesting, and us investment guys can talk about what's coming on economically, but that's not what's on my mind. What I'm more focused on is what the social and economic consequences are going to be to the general populace and what kind of uprising socially and nationalist revolt it could bring about. You see Juliet de Klerk expressing a lot of understanding of the yellow vest view in France. Now we have Chris Cole, one of the smartest guys in the entire industry, saying literally, we're headed toward a big event, but watch more actively what the social and populist consequences are going to be. And I think that where markets are most at risk, if we want to keep focused on just the market aspect of this at first anyway, is there's so much complacency that, we're going to get to another market event and the Fed's going to have our back like they always do, and they're going to come bail us out and it's all going to be hunky-dory. I think what you're going to find is it starts that way, and the Fed wants to bail Wall Street out again like they did in 2008. And all of a sudden, the yellow vest kind of movement that you see in France is all across America. And it is just a hell no, we won't go. We're not going to allow the government to bail Wall Street out at the expense of the people again. And I think what you might see is suddenly there is no backstop for financial markets. And in some ways, it really is in the best interest of the broader populace that the government backstop financial markets to protect the overall system. But in terms of public sentiment, now bailing out Wall Street is not going to play politically. And I think that we are potentially at the point where the divisiveness that has been growing in the United States, so many people think it's about Donald Trump. And regardless of whether you're pro or anti-Trump, I would contend this is not about Donald Trump. This started long before and will continue long after Donald Trump. We see a fourth turning event going on here where there is more and more political extremism, and there's more and more people becoming infuriated and demanding demanding radically different leadership. And there will be support, as there always is in fourth turnings. If you read Neil Howe's work, there will be support for radical leaders on both sides. And I'm reminded of the comment that Luke Groman made in our year-end special last year when he said, look, if you don't like Donald Trump, just wait till you see the guy they elect next. And I think that we're headed toward real political turmoil that could surprise everyone in financial markets when they realize that, yeah, there's an economic event coming, but the social event is going to be a much bigger deal than the economic event. And that will be the big difference from 2008 to what begins in 2019 and probably doesn't really play out until 2020.
It's going to be so interesting to see how the next decade plays out. So many big elections coming up. And, these things take time to develop. It's not something that just happens like a vol event blow up where it's just like one day it's here. But you see the seeds being planted for these problems that are just going to keep getting bigger and bigger. But I wanted to move on, and I wanted to touch on his comments on the end of the low volatility regime, because I believe that generally, like in terms of regimes, there's these trends that happen where certain things work very well for extended periods of time and they become incredibly popular and things shift. And one of the things that has been part of this low volatility regime has been the passive investing and the growth of passive investing, and the fact that we've seen such a huge decline in active managers and everyone indexing to save fees and to try to create outperformance. And that really has been something that's been a part of that low volatility regime. But the question is, if the low volatility regime is dead, what does that mean for passive investing? Because Chris was talking about the growth of potential macro funds, the specific CTA funds, or long volatility strategies, which of course Artemis does. But it'll be really interesting to see how this begins to evolve in the next decade. And the fact that this is just the first inning of this. Do you really believe that passive investing is dead?
Oh, I think that there is a very cyclical process that is a reflexive cycle. And the way that it works is that when active management is popular and everyone's doing it, it defeats itself. You can't have everybody running active management and beating the market because somebody has to lose in that game. More than half of them lose because the few people that are really good at it are exceptionally good at it. And the result is you have this perception that active management doesn't work. As soon as everybody goes to passive management, that opens the door for active management to start working again. And we've reached what I think is a plateau in a maximum, we're at peak passive management right now. And so we're already seeing the smartest guys in the room dramatically outperforming the market in hedge funds. And I think we'll continue to see that, and active management will make a huge comeback. And eventually active management will be the favored thing, and it will stop working because what allows it to work is that it's not popular. As soon as it is popular, it'll stop working and we'll see another cycle. So it's a self-reinforcing reflexive cycle, and we're right at a turning point, I believe.
And one of the most popular themes amongst active managers is value investing. And, we see that Double Line launched a new value fund, but there's all sorts of these trends coming out where value investing is becoming more in fashion. It's going to be interesting to see whether the value theme becomes a really big thing in this transition.
Well, Patrick, I couldn't agree more, and I guess I would say I have to very much agree with Chris and Ray Dalio and others that all of us who have a deeper understanding than the general public of these economic events that are coming, we really need to think about our responsibility in society as the people who understand what probably is going to become a social crisis and a populist uprising and social unrest and violence crisis in the United States and the entire West. And I hate to say it, but my prediction is that we're going to see more, not less, populist uprisings and violence and left versus right conflicts and violent conflicts between people that are supporters of different political parties and so forth. I think it's going to get a lot worse before it gets better. I certainly hope to be be proven wrong. In any event, folks, we need your help promoting MacroVoices, so please share your Research Roundup emails, tell your friends about MacroVoices, and most importantly, register your free account. The benefit to you is you'll receive our free Research Roundup email, which never contains any advertising or marketing. It's just a compendium of links to all of the best content that we could find free on the internet each week. Patrick, tell them what's in this week's Research Roundup.
Well, this week you're going to find the transcript for today's interview, as well as a link to our 2018 interview with Chris Cole and the corresponding chart book. There's a link to an article from Ray Dalio looking back at the last 40 years of reforms in China, and an interesting article on the Fed titled, "It's Fun and Games Until Someone Asks About the Balance Sheet." So you'll find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com or tag it with the MVRR hashtag on Twitter, and we'll include it in our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.